Tim Roughgarden.
Thanks, everyone. Good morning. Good to see everybody. So I have a research presentation. It's going to be something like ballpark 30 minutes. Obviously, happy to take Q&A on this work at the end of the talk. But then, if there's extra time, also just open it up to the floor if there's anything else on your mind that you wanted to chat about. Okay, but let me first talk about some recent work I've been doing. Have some really great co-authors on this work. So Jason Milionis is my PhD student at Columbia University. By the way, are there two mics on? Okay. This is on or that's on? This is on. Okay. I think that's on too. All right. So Jason is my PhD student at Columbia University. Siamak Moalemi, he's a colleague of mine. He's in the business school at Columbia. Anthony Lee Zhang is a professor in the business school at Chicago. And this work is about something we call loss-versus-rebalancing, so LVR, pronounced lever. So what is this about? I want to think about the incentives that are faced by liquidity providers and automated market makers. Okay, so in an AMM, like say Uniswap, there's really sort of two types of participants. Right? So on the one hand, you have traders, obviously. So they might be buying and selling something like say ETH in exchange for USDC. Now the tokens that they're trading, right, they have to come from somewhere. And so they're provided by what are known as LPs or liquidity providers. So these are entities that make deposits of tokens, of coins, into the automated market maker so that to enable traders to trade. And they generally do that in exchange for a share of the trading fees. And probably most people sort of in this room are sort of well aware that AMMs are really big in Web3. And so it's particularly, it's one of the biggest parts of DeFi, of decentralized finance. Like if you look at sort of gas usage, on Ethereum, it's very common that like the majority of the gas usage is going toward operations of AMMs. Okay, so they're really, really central in DeFi in particular and sort of Web3 more broadly. Why do people love them so much? Well, one thing is they're very simple. So you can sort of implement them completely on chain, unlike more complex sort of order book formats. And then also, they're really good at guaranteeing liquidity for sort of long tail assets that would otherwise be stuck in sort of a very thin market. And so I want to just study a sort of really basic question, which is, when does it make good economic sense to be a liquidity provider? That is, when does the benefit to you exceed the cost? And this talk is going to be mostly about the cost side of the equation, because the benefit's pretty straightforward, actually. The benefit of making a deposit is you get some share of the fee revenue, and maybe in some cases you get some extra token awards as well. So rewards is pretty straightforward to think about, but like, what about the cost part of this equation? And your first thought might be, like, why is there a cost at all, right? You sort of deposit some tokens, people trade with it, what's the big deal? And the key source of cost that I want to focus on is something known as adverse selection. Okay, and this is really part of the price of doing business as a market maker. So what you're worried about is you're worried that, when someone trades with this AMM, that they're an informed trader, by which I mean they know more about the current market price of the asset than the AMM does. And so in that case, right, so an automated market maker at all times is quoting a spot price at which it would be willing to buy or sell. So willing to take either side of a buy or sell order at the same price. And so if all of the traders are informed traders that have sort of advanced or better knowledge about whether the price is going up or going down, as the AMM, you're basically going to be taking the wrong side of every single trade. Okay, so that's what I mean by adverse selection. The trades that you wind up accepting are exactly the trades that are the ones that are not in favor. Okay? So that's the concern. That's where cost is going to originate from, adverse selection. And so we want to characterize that as precisely as possible. Okay, and so I hope that strikes you as kind of a very basic question. Obviously, if you're contemplating being a liquidity provider yourself, this is kind of exactly the question you want to be asking. But then there's also downstream implications if you're designing an automated market maker, right? Because an AMM can only be healthy if it has happy LPs, happy liquidity providers. If happy liquidity providers, you want their benefit to be more than the cost. So it behooves you to understand the cost of your LPs for designing an AMM. We'll come back to that on the final slide. Okay, so before I start walking you through kind of our theory, our framework, let me just sort of upfront sort of tell you about one really, really specific instantiation of our theory. I'm going to do this, one, just to sort of add concreteness early in the talk, but I also want you to immediately appreciate that this theory is going to give us sort of very precise quantitative predictions about this question. So let's think about like the most perhaps the most canonical type of automated market maker out there. Let's look at a so-called X times Y equal K curve, also called a constant product market maker. This would be what you find in like Uniswap V2, Sushi Swap, lots of other things copied all over the place. Let's suppose let's continue with the example of exchanging ETH for USDC. Let's suppose the trading fee is fixed, let's call it 30 basis points. One really important parameter is going to be the volatility of risky assets. So in this case, the volatility in ETH. That varies a lot over time, but 5% daily volatility is not a crazy number for what you often see for volatility of ETH. So what our theory is going to do, it's going to take all this stuff as inputs, the kind of AMM you're talking about, the volatility of the risky asset in that AMM, and it's going to spit back out a very precise number, cost and delivered by. So in this case, with these inputs, the output of our theory says that providing liquidity to this pool costs 3 1/8 basis points a. This will be about 11% loss of your deposit annually. So, okay, so is that number big or small? Well, of course, all of this is wrapped up in this cost benefit analysis. So that whether it's big or small depends on what the benefit is, what your fee revenue is. And if you have a fixed trading fee like 30 basis points, then your revenue is just, it's just linear in the volume. Okay? So if the volume's high enough, you're going to be happy losing 11%. If the volume's too low, you're going to be unhappy losing 11%. Our theory tells you exactly what the break-even point would be. So basically, you'll break even if the daily trading of this pool is roughly 10% of the pool. More volume than that, you'll be in the black. Less volume than that, you'll be in the red. Okay. So we'll get back to where this comes from, but this will be one very specific case of what our theory can tell you. Okay. So before I tell you how to derive results like that and sort of reason about potential future investment decisions, let's start by talking about something that's hopefully useful, just kind of doing forensics on the past, right? Like suppose we literally just unlocked a deposit in an AMM. We deposited in an ETH USDC, maybe 1 ETH, let's say, and 1,000 USDC. We deposited that in an automated market maker. 1 month later, we withdrew, and we just want to say, okay, well, just in hindsight, did it look like a good decision to provide liquidity to this AMM? Let's start with that question. So how should you do this? This is a very simple question. Even this is a little tricky. Maybe the most obvious I can tell you that. Maybe the most obvious I can just be like, look, we deposited some stuff. It had some cash value when we deposited it. We withdrew a month later, we got some stuff. And that had some cash value. And if the second number is bigger than the first, let's call it a good decision. For example, maybe we deposited 1 ETH and 1,000 USDC, and a month later we withdrew. Now, the way AMMs work is you'll generally get back a different mixture of the assets, depending on how market prices have moved in the meantime. So maybe when you withdraw, you get back half an ETH and 2,000 USDC. And you want to say, okay, is one of these better than the other? Well, you can't actually answer that question. I'm going to tell you what the price of ETH is. So let's say it was a really good month for ETH. Let's say at the beginning of the month, ETH was trading at $1,000, and at the end of the month, it was trading at $4,000, so it quadrupled. Okay. Well, now in hindsight, this looks like a pretty good move, right? You literally doubled your money. Okay. You deposited $2,000 worth of assets, you withdrew $4,000 worth of assets. That's even setting aside any kind of additional fee revenue that you got. So it seems like thumbs up. But this is actually really sloppy thinking. Actually, very, very sort of bad way to assess your decision. Because when you provided liquidity to this AMM, one thing you did in particular as part of that strategy is hold on to some ETH. This was a month where ETH quadrupled. Literally anything you could have done that involved holding some ETH would be looking pretty good. Right? So what you really wanted, the sharper question, right, is to ask yourself, compared to the other ways I could have gone long, had exposure to ETH price potentially increasing, among the ways I could have done that, how does the specific strategy of providing liquidity to an AMM compare? Okay. All right, so if you wanted to go, so like what would such a strategy look like, right? What else could you do if you wanted to go long? Well, like the really obvious thing to do is hang on to it, okay? Simplest way to go long. So you can compare how well you did with your sort of AMM deposits to how you would have done by just holding those assets. In our example, you would have done better. because you just held on to them. It's the 1 ETH plus USDC. You'd still have that at the end of the month. The price of ETH has quadrupled. It's 4,000. So now your portfolio is worth $5,000, whereas your withdrawal from the AMM would have been worth only $4,000. So in some sense, the loss versus holding, okay, in this example would be $1,000. You would have made $1,000 more just by holding the assets. If you've ever heard of the phrase impermanent loss, this is generally what people mean by it. The loss that you incurred by depositing in the AMM relative to the value of your portfolio had you not done, had you just held on to those assets. Okay. So this is definitely a less bad idea than idea number one, because you are comparing yourself to some practice strategy. You're comparing yourself to a long benchmark. Okay. And people talk about impermanent loss a lot, but it's definitely got some issues. And if our goal is to really sort of isolate the adverse selection costs faced by liquidity providers, this is not the right thing. There's a few ways to see that. Let me just tell you one. Let's think about sort of the very special case where it just so happens that at the end of the month, the price of ETH returns to where it started. So let's say 1,000 at the beginning of the month, 1,000 at the end. Maybe it's because the price stayed constant the whole time. Maybe it jumped around a ton, but it eventually made its way back to 1,000. Okay. Price at the end is equal to the price at the beginning. Well, a property of pretty much all AMMs is that if the market price of the assets at the time of withdrawal is the same at the time of deposit, you get back exactly what you put in. Okay, so you will get back your same 1,000 USDC. If the price at the time of withdrawal is exactly what it was, still 1,000. So that means depositing in the AMM was literally exactly the same thing as holding. There's no distinct difference between had you just held the assets. So it's not working. Oh, okay. All right. Sure. Check 1, 2. Okay. Good. Okay. So if it just so happens that the price returns to its starting point, you'll withdraw exactly what you deposited. It's equivalent to holding. So the loss versus holding or the impermanent loss is going to be 0. And again, let me emphasize the impermanent loss is going to be 0, whether the price stayed constant for the whole month or whether the price jumped all around during the month and eventually returned to its starting point. Okay? And the fact that impermanent loss depends only on the final and starting prices and is independent of the trajectory, that should kind of bother us, actually, if you think about it. And even if you're like not at all a DeFi expert, even if you just sort of read casually some articles, this should seem not quite right. Like, you know, if you've ever sort of, you know, you've probably heard about arbitrage on AMMs. Okay, so if you've ever, for example, heard a talk about MEV, I'm sure you've heard about arbitrage on AMMs. So what's the idea? The idea is if the spot price being quoted by an automated market maker is different than what the asset's trading for on the open markets, well, then you can expect arbitrageurs to sort of come in and correct the spot price of the AMM. Okay, so for example, if ETH is 4,000 on Binance, but the 3,000 spot price in an AMM, well, then it looks really cheap to buy ETH from that AMM. You expect arbitrageurs to do that until they drive the price up to match the open market price of 4,000. Arbitrageurs do not do this out of charity. They do this because any correction of a stale AMM price results in their profit. So if arbitrageurs are making money, where is that money coming from? Well, as we discussed, there's really only 2 participants in an automated market maker. There's the traders, arbitrageurs in particular, and there's the liquidity providers. So if the arbitrageurs are making money, that presumably is at the expense of the LPs, of the liquidity providers. So that means we should expect, if we actually have a good measure of adverse selection costs of LP losses, that should be increasing in the opportunities for arbitrage. Okay? If the price never changes for a whole month, there are no opportunities for arbitrage. If the price is jumping around all over the place, there are lots of possibilities for arbitrage. So we should somehow expect our loss measure to be increasing in the volatility of the assets and how much that price is moving around. As we see, impermanent loss doesn't at all have that property. Okay, so a dependence on the price trajectory, I think, should be a necessary condition for a good measure of loss to LPs. Okay. All right. So again, that idea 2 is definitely less bad than idea 1. Like, you are at least comparing to a reference strategy. And so what we've learned from that example is that maybe if we're going to do that, we just need a more nuanced reference strategy. Okay, and so that's what I'm going to introduce to you next. That's going to be known as the rebalancing strategy. That is the R in lever, loss versus rebalancing. So the rebalancing strategy, it's going to depend on which AMM you're talking about. So let me introduce it in sort of the simplest, most canonical AMM of a constant product market maker, okay, or an XY equals K curve. This will also be the case where it's most obvious why I'm calling it a rebalancing strategy. So a constant product market maker, it's not usually described this way, but actually what it's doing, it's really implementing an auto rebalancing strategy for the portfolio. Okay, so this type of AMM always quotes a spot price with the property that the cash value of the two sides of the pool are going to be exactly the same. So if you have a constant product market maker and it's got $10,000 of USDC on one side, you should expect an amount of ETH on the other side whose cash value at the current market price of ETH is also equal to 10,000. Okay, so constant product market makers quote spot prices that equalize the cash value of the two sides of the pool. You do a little arithmetic and you find out that that's a spot price of Y over X. Here, Y would be the quantity of USDC, X would be the quantity of ETH. So notice as X gets smaller, as ETH gets scarcer, the price of ETH is going to go up, as you'd expect. So the more of it that you buy from an AMM, the higher the price is going to be, okay? Now, the way you actually implement this practically is you just implement this implicitly through an invariant function. And this is where the XY and XY equals K comes from. So basically what you do is you insist that trades are only allowed to move around on a level set of some invariant function. So this here is a level set of the function X times Y, the product of the quantities of the two tokens. If you just sort of do a little calculus, implicit function theorem, you realize that actually just forcing trades to stay on here is exactly the same thing as always quoting a spot price of Y over X. Okay, it's exactly the same, right? Okay. So that's a review of XY equals K, and this is the sense in which they actually are doing rebalancing on your behalf. So now let me tell you what's the corresponding rebalancing strategy, the new benchmark strategy we're going to look at. It's going to be defined trade by trade. Okay, so let's just look at one trade. So let's suppose, again, we have a pool. Whoops. Let's suppose we start with one ETH and 1,000 USDC. Imagine that the open market price of ETH, let's say on Binance or something, suddenly quadruples, suddenly jumps up to 4,000. As we said, now all of a sudden buying ETH from this pool looks super cheap. So you expect arbitrageurs to buy ETH from this pool until the spot price of the pool matches the market price of 4,000. That is going to happen. If you do a little arithmetic, that will happen after arbitrageurs purchase 0.5 ETH from the pool. And then at a per ETH cost of 2,000. Okay, so then you'll notice, right? You have 0.5 ETH, 2,000. You plug that into Y over X, you get 4,000. Okay, so that adjusts it back to the open market price, and at this point, the value of the assets in the pool is 4,000. Okay. All right, so that's what happens in the AMM. What is the reference strategy, the rebalancing reference strategy? Okay, so this is a key point. In the rebalancing strategy, what you do, by definition, you copy the trade that was made in the AMM. Okay, so here the AMM, in effect, sold 0.5 ETH. In the rebalancing strategy, you will also sell 0.5 ETH, but you will do so not through the AMM, but on the open market. So for example, on Binance, okay? So the open market price is now 4,000. So you're going to purchase 0.5 ETH at a price of 4,000. You're definitely going to be doing better than this AMM, which in effect sold 0.5 ETH at a per ETH price of 2,000. Okay. So the rebalancing strategy will net you $1,000 more than what happened in the AMM. Again, because the 0.5 ETH that you sold was at a price of 4,000 rather than 2,000. Okay. So that's the lever for a single trade. Lever accumulates trade by trade just by summing. Okay. Let me actually continue the example, because remember we critiqued impermanent loss on the basis that it was independent of the price trajectory. So let's examine that point for this new quantity lever. So suppose now that the ETH price drops right back to where it was. Okay, it jumps back from 4,000 to 1,000. Okay. The AMMs are basically kind of reversible. So an AMM is just going to revert back to its previous state. In effect, it will buy back that same 0.5 ETH at that same per ETH price of 2,000. So what is the rebalancing strategy going to do? Again, it's going to copy the trade of the AMM. So it will itself buy 0.5 ETH However, it will do so on the open market. The open market price at this point is 1,000. Okay, so again, the rebalancing strategy will be better off than it would have been in the AMM. Okay, it would have bought 0.5 ETH, but at a price of 1,000 rather than 2,000. So here again, you accumulate loss versus rebalancing of 500. So 1,500 lever combined for the first two trades. And so I hope you find this example. It feels like we're on the right track, actually. So first of all, unlike impermanent loss, we immediately see that lever does indeed depend on the price trajectory. Okay? If the price never moved at all, right, well, then the lever would be zero, right? There's just literally nothing happening. Here we see that if the price jumps up and jumps back down, the lever is not zero. Okay, it's positive. So that's a good sign. It's also satisfying that it just keeps adding up trade by trade. Lever doesn't like cancel across different trades. It just keeps accumulating. Why does that make sense? Well, we wanted to isolate the adverse selection costs faced by liquidity providers. And remember, every single trade you make as an AMM, okay, whether it's a buy or a sell order, every single trade, your concern is that you're on the wrong side of a trade with an informed trader. Okay, that your price is either too high and someone's going to sell to you, or that your price is too low and someone's going to buy from you. Okay, so every trade runs risk of adverse selection. So indeed, it seems like our measure of loss should be adding up over the trades, which is the case here. All right. So having told you about the rebalancing strategy for the special case of a constant product market maker, I think it's now easy to tell you the definition in general. So again, it's just going to be summed up trade by trade. And for a given trade, what you look at is you look at the quantity traded. So this would be like 0.5 ETH in our example. And then you look at the difference between the two prices, one being on the open market. Again, think of that as like Binance, and the other being the price that it's executed at in this AMM. Okay. And so you'll notice that you will accumulate lever. Okay, this will be positive. Okay, if you're selling ETH, so if AI is positive, if you're selling ETH at too low a price, okay, if Q is less than P, or if you're buying ETH, in which case A is negative, at too high a price, meaning Q is less than P. Okay, in both of those cases, you will be accumulating lever. Now, this depends on the AMM. Why? Because Q, the price of execution on an AMM, will depend on what AMM you're talking about. Okay, P is exogenous. P is just the price on the open market. We're just thinking about fixed quantities of trade. And for a given quantity of trade, different AMMs will quote you different prices Q. So that's why this is different for different AMMs. Okay. So that is the definition of lever, okay, for an arbitrary AMM and a sequence of trades. So you can tell the story of lever in many different ways. I'm emphasizing in this talk the narrative where we sort of start from impermanent loss and tweak it so that we have a sort of better reference strategy to get a cost measure with better properties. There are some very different ways you can tell the lever story, however, which is a good sign. Okay, whenever you're introducing a definition, it's a good sign if there are multiple, seemingly quite different natural interpretations of that one definition. So let me tell you a little bit about the other interpretations. So very easy proposition. We've been talking about lever as losses to liquidity providers. You can equivalently talk about them as sort of best case profits to arbitrageurs. Best case meaning like if arbitrageurs happen to have access to sort of a very liquid market, like say Binance with sort of a very deep order book, and if they don't pay any transaction fees, lever is actually exactly the profit that arbitrageurs can capture. Okay. This should not surprise us, right? We talked earlier about the effective zero-sum game being played between traders on the one hand and liquidity providers on the other. So we shouldn't be surprised to see the best case arbitrage profit corresponds to, in some sense, worst case LP loss. Okay, so that's what this is saying. So another one, for those of you that are kind of more coming from a finance side, okay, so I've talked about AMMs as if they're intrinsically long on the assets in the pool. It's an intrinsically long strategy. And if you're not doing anything other than LPing in a single pool, then indeed you are going long on those assets. But there are standard methods for so-called delta hedging, that long position. Okay, so having an equivalent short position elsewhere, so that as a liquidity provider, you are actually completely sort of immune to any price changes in ETH. You literally don't care about how ETH moves around. You're just going to be balancing your long position with an equivalent short position, and in that sense, breaking even. So another very easy proposition is that if you are doing that form of delta hedging, then lever will be your net loss. Okay? That is how much you will lose by depositing in an LP and then hedging equivalently. So you can think of lever as like the unhedgeable residual cost of doing liquidity provision. Okay, and again, that's just really a quite easy proposition. So those are three interpretations of this quantity. Loss to LPs with respect to a rebalancing strategy, gained by arbitrageurs, or sort of the unhedgeable part of the loss incurred by an LP. Okay? So, and I encourage you to think of this as, you know, accomplishing the goal we set out to, which is isolating the adverse selection costs faced by LPs. Right? It accumulates trade by trade, depending on to what extent the AMM execution price is inferior to what's happening on the open market. All right, so all of this has been about the forensics question, like looking at data in the past and asking yourself, did you make a good decision or not? Now I want to talk about the question of predicting the future. Okay? Probably more interesting, right? You can reason about potential future liquidity provision decisions. Also, I still owe you that promise I gave you on the second slide of where that 3 1/8 basis points comes from. And that comes from this model of reasoning about the future, okay? So when do we expect LPing to make good economic sense? Well, it's going to be when the sort of, you know, the benefit, meaning the fees you earn, is bigger than the cost, meaning bigger than the lever. So you have to reason about what you think the lever is going to be, okay, and what you think the revenue is going to be. Lever, as we've seen, depends on the price trajectory, okay? So to reason about what we think the lever might be, the only way to do that is to introduce some model for how we might expect prices to move in the future. There's multiple ways you could do that. Okay, we chose what's, you know, perhaps the sort of, you know, most basic starting point. Okay, you could imagine doing more sophisticated things, but we wanted to just sort of start simple. So we use what's really just the standard model from continuous time finance. So the Black-Scholes model. Okay, some of you will know this, some of you won't. It's fine if you don't. So basically, the price of ETH is going to be evolving according to geometric Brownian motion. And if you don't know this model, the main thing you should know is there's basically like one just really important parameter in this model, and that's the volatility sigma. Okay, sigma being 0 corresponds to a price that never moves. Sigma being big is a price that's jumping around like crazy all over the place. Okay, if you're sort of thinking of returns as basically being like a random walk, you can loosely interpret sigma as like the typical length of a step in that random walk. Okay. So that's going to be the mathematical model. And we'd love to just sort of characterize mathematically what is lever in this model. So what is that answer going to look like? It's not going to be like a constant like 2 or something. Lever is going to depend on a couple things, right? So first of all, right, it's going to depend on sigma, right? Intuitively, you know, we've talked ourselves into the idea that the bigger sigma is, the more stuff's moving around, the more arbitrage, the worse for the LPs. So expecting lever to be an increasing function of the volatility sigma, that's number one. Secondly, as we saw earlier, lever depends on the AMM in question. Okay, remember we had that formula with the A's, P's, and Q's, and sort of holding the A's and P's fixed, different AMMs give you different Q's, so give you different lever. So at a minimum, the answer to this question has to depend on the AMM and on the volatility sigma, which means the best thing we could hope for would be a hopefully quite clean formula just in terms of sigma and in terms of the AMM of exactly what the lever is. Right? That's kind of the simplest thing that might work out. And you know, to some extent, whether this is clean or not, it's in the eye of the beholder. I think it's pretty clean. And as we'll see on the next slide, for common AMMs, this is going to simplify dramatically. But even for a completely arbitrary AMM, you can in fact characterize precisely what is the lever in this model that I just introduced. Okay. So remember, lever accumulates trade by trade. And remember, we've moved to this sort of standard continuous time finance model, the Black-Scholes model. So trading is literally happening just all the time, just happening constantly. So that's why you're seeing this integral from the starting time to the ending time t of some instantaneous lever. Okay? It's just accumulating all the time. So, and P sub S here denotes the price of the asset on the open market at time S. Okay? So what's the instantaneous lever? So at a given moment in time S, how rapidly is it sort of going up? Well, this is the exact expression here. Okay, so -1/2 times quantity sigma PS squared times the marginal liquidity of the AMM at the current market price P sub S. Okay, so what do I mean marginal liquidity? right? So like imagine, the price of ETH sort of jumps a little bit from 1,000 to 1,001, okay, on the open market. So that means arbitrageurs are going to buy a little bit of ETH from your pool to drive the spot price of your pool up to 1,001. And so this is just saying how rapidly does that happen? Okay, with a little bit of a price increase, how rapidly does the quantity of the asset your pool has drop? Okay? So if it's very liquid, this is going to be very big. If it's very illiquid, this is going to be very small. If it's very illiquid, you don't need much of a quantity change to affect a big price change. Okay? And this is also going to be negative, right? So we have a minus sign there, and always the quantity drops as the price goes up. So this will also be negative. So this is going to be a positive quantity or non-negative quantity, as you'd expect. So this is just then increasing function of time. Okay, lever just accumulates steadily over time. Okay. So we expected dependence on the AMM, and that enters in actually a quite simple way. At a given moment in time, all you care about is the marginal liquidity of the AMM at the current market price. You don't care about anything else about the AMM for the instantaneous lever. And we expected it to depend on sigma, and indeed there's your sigma squared, in fact, dependence. Okay. So this is a theorem that's true in general. Any AMM, you can characterize the lever by this formula. So I promise that this simplifies for popular AMMs. The paper has several examples, Balancer, Uniswap v3, et cetera. For the talk, let me just talk about sort of the simplest one, and again, go back to the constant product market maker. So an XY equals K curve. So this is just copied from the previous slide. That's what we had before. And so let's think about an XY equal K curve. It's more convenient to work with root K, so let's call that capital L. So the bigger capital L is, the more the liquidity there is in this pool. And it's really just arithmetic. Okay, so really, what are you going to do? Okay, you're going to take this, you're going to look at this integral, you care about the instantaneous lever, so that's some expression. I guess we need to figure out what the marginal liquidity is, what's dx by dp, right? But I mean, it's a very simple AMM. It's just defined by this very simple invariant function, x times y, little calculus, implicit function theorem. You can just solve for the marginal liquidity at a given price, and this is what it is. Okay, 1/2 times L times P sub S to the minus 1.5. Okay, whatever, it doesn't matter what this is. All I want you to know is that a little calculus just gives this to you directly. Okay. Now we literally just plug in the marginal liquidity into our instantaneous lever formula, and we get what we get. Okay, 1/4 times the liquidity times volatility squared times the square root of the market price. And this becomes very interpretable once you normalize it. So let's think about the instantaneous loss, the instantaneous lever relative to the value of the assets in the pool. Okay. So for a constant product market maker, you can also very cleanly express the value of the pool. Okay, 2 times capital L times square root of P sub S. Remember, these pools equalize the two sides of the pool, so each side has value of the liquidity times the square root of the market price. And if you look at that ratio, you actually get a bunch of cancellation, and you find out the instantaneous lever of such a pool is always sigma squared over 8. Doesn't even matter what the current market price is. It's always sigma squared over 8, where sigma is the volatility. Okay. Now I can tell you, now we can plug in numbers and recover that example from the beginning of the talk. Remember there we were thinking sigma of 0.05, 5% daily volatility. If you plug that in, you indeed get 3 1/8 basis points, okay, daily loss to LPs, which again corresponds to roughly 11% annual. And again, remember, this tells you what's the break-even point for an LP, okay, to be happy. That's going to depend on volume. So remember, when we're thinking about a pool with a fixed trading fee of 30 basis points, what we discovered is that the break-even point was volume around 10% daily of the pool's assets. More than that, you're in the black. Less than that, you're in the red. Okay. And again, just to be clear, the theory is not about these AMMs in particular. This is just for illustration. You can see the paper for many more examples. All right, so that wraps up what I wanted to cover. Let me just sort of tell you the takeaways and some implications. So this is a new cost measure for LPing in an AMM, and we argue it's really the first measure that properly characterizes and isolates the adverse selection costs that the liquidity providers face. And I want to remind you, I told the story in a particular way, kind of a parallel to impermanent loss that uses a more nuanced rebalancing strategy rather than a holding strategy. But don't forget, there's other ways to think about lever as well, as the best case profits extractable by arbitrageurs and as the sort of unhedgeable loss. So even if you're sort of doing delta hedging and you're sort of neutralizing price movements of ETH, there still remains this lever that you sort of can't do anything about as a liquidity provider. So how does this answer the question? How does this help potential liquidity providers? Can you advance the slide from up there? It's not advancing for me. Okay, great. Good. So hopefully it was clear, right? That summation formula I showed you in the middle of the talk. Hopefully it's self-evident that that could be easily computed from the kind of public data that we have around AMMs and sort of traditional prices on Binance, for example. And as we just saw, mathematically, in a sort of natural model of price movements, you can actually compute it in closed form. And it's particularly simple for many popular AMMs. So how does this help liquidity providers? Well, it tells you, when to make a deposit, right? So if you're expecting your fee revenue to be bigger than your lever, then that's a potentially good investment decision. Otherwise, not. And then going to the, putting instead on the hat of someone who's designing an automated market maker. Again, for your market to be successful, you need happy liquidity providers. You need happy liquidity providers. You need to make sure that their fee revenue is high enough to counteract the lever. So what are the implications then for AMM design? Well, lever, remember, depends on volatility, depends on sigma, and actually in a pretty extreme way, right? So if volatility doubles, the break-even volume is going to quadruple. Okay, so as sigma moves around, the volume or in general, the revenues that LPs need is going to go up quadratically in sigma. Whereas revenue, meanwhile, depends on volume. Okay, and so that means you may want to think about dynamic fees that pay attention to these two key parameters, okay, volume, volatility. So you could adjust fees based on recent empirical values of those. Or if you wanted, you could just look directly at recent empirical lever and adjust fees according to that. Second implication, right? So all else being equal, as an AMM designer, obviously you want lever to be as small as possible. Okay, you want LP losses to be as small as possible because then that minimizes the sort of revenue they would need to keep them happy. So how would you reduce lever? Well, different projects are exploring different ideas. But one thing that one could think about doing is rather than just naively quoting the spot price of the AMM, naively quoting Y over X without paying attention to anything else that's happening in the world, you could try to quote better prices that better reflect what's happening on the open market. For example, by using a high frequency pricing oracle. Now, oracles, of course, open up a whole new can of worms, but this theory sort of quantifies the benefit that an AMM would get were it able to safely incorporate a pricing oracle or prices that are closer to market prices. Okay, so I'm not saying these are ideas new to this work. My understanding is there's multiple projects sort of coming out or about to come out that are using these and related ideas, but hopefully this work does put these kinds of ideas on more sound mathematical footing. Okay, so that's what I wanted to say about lever. Let me stop here, take questions on lever, and then just open the floor for other questions as well. So thanks very much. Questions? Yeah. Yeah, that's a good question. So so you're absolutely right. Our model is that the price discovery is happening outside the AMM, for example, on Binance. And then pretty much we're basically doing it's basically a worst case measure of LP loss that effectively assumes that every single trade is informed. And I think to what extent that model is reasonable, I think it depends a little bit on the pair of assets you're talking about. I think for really high volume pairs, from our preliminary sort of look at data, it seems not crazy. It seems actually perhaps true that most of the price discovery is actually happening on your Binances, and then the AMMs just get corrected. It is an open question how you would adapt this theory if the price discovery is happening on the AMMs as well. We haven't thought about it that seriously. I think it should be a doable research project, but that's still open at this point. So great comment. Yeah, there's been several that have contacted us on the spot. I don't want to try to remember their names because I might get it wrong, and I'll probably forget some of the people I've been talking to. And we can follow up later, and I can pass you the names of some of the projects that have reached out to us. Yeah, yeah, yeah. Yeah, that's a great, so the question is about, you know, how would you do, do I have any proposals for how to actually do dynamic fees? Or if you want to make it even more complicated, imagine like you're allowed to do emission rewards, right? So you're allowed to sort of, you know, either for the underlying L1 or for the project itself, maybe you give out tokens as additional rewards to LPs. All of that's, you know, I think important research to do. And I do expect, you know, we're going to be working on it. I think others are going to be working on it over the next year or two. The one thing I'll point out now is that would definitely require, you'd need a richer model. Okay, so what I've told you about today, you know, really all you need to do is assume some model of sort of price movements of the risky asset and you get an answer, right? So if you wanted to talk about like optimal fees, you would need to have a notion of how consumers respond to changes in fees, right? Because there's competition between different markets, right? So for example, right, like if you notice that volatility goes up, right? Maybe the obvious thing to do is like, okay, let's like crank up the like trading fee from 30 basis points to 120 basis points because we just noticed that volatility doubled. But then of course, less people might trade, probably less people will trade on your market, right? And so then it's not even clear that sort of like, you know, revenue goes in the right direction. So there's this interplay between, you know, so you need some kind of behavioral model for why people might or might not LP to reason about those questions. It's not to say that can't be done. It can definitely be done, but it's just not. It's not something. It was outside the scope of this sort of first step that we wanted to take here. Yeah, and then the emission rewards is a really kind of cool question that then gets even more tricky, right? Because now you're talking about like also macroeconomic issues with respect to kind of that cryptocurrency, but also a very interesting question. Yeah, in the brown shirt. Yeah, great question. I think this is maybe like the most obvious next step to take the work. Okay, so the comment was like normally the comment, you know, first correctly points out that this is, you know, that this measure is exact in the event that you only have arbitrage traders. Now, it doesn't mean it's irrelevant when you have other traders as well, because this still gives you an upper bound on LP loss. It's like the worst case LP loss. So in other words, like if you expect your revenue to be bigger than the lever, you should definitely be good to go. And then maybe you'll even do a little bit better than you thought because there'll be less arbitrage traders than you thought. You could definitely imagine it would be desirable to have a sort of more, right? So also part of the comment was, you know, if you look at traditional sort of economic approaches to analyzing market microstructure, usually there's sort of a mixture of arbitrage traders and noise traders or idiosyncratic traders. With the idea being that as a market maker, you lose money because of adverse selection to the informed traders, and you make money from the noise traders. So first of all, I still think actually, you know, AMMs, the idiosyncrasies of AMMs, I think make this a more reasonable model than normal to actually ignore noise traders, to think of all the sort of noise traders as just happening on a centralized exchange and only arbitrage happening here. That said, it would be very natural to try to extend the model with some kind of mixture of noise traders and arbitrage traders. There again, you would need to make more modeling assumptions. On the other hand, you know, like the Black-Scholes model, there are standard ways of doing that. And that's a very, like I said, it's maybe the most natural research direction to pursue next. Yep. Say it again. So the question is about V3 versus V2. Yeah, so the paper includes full derivations for V3 as well, right? So there, I mean, it looks a little messier because you have to like parameterize on like what's the range in which sort of people have and which liquidity is available. But you can turn, I mean, the crank we saw a couple of slides ago, you can just crank that for V3 as well. Yeah, I think So the question was, should the model incorporate aspects of liquidity fragmentation across, say, different, L1s and L2s and that kind of thing? For the work here, I'm not convinced that's crucial. I mean, here the mental model is just, we're isolating one AMM and we're just assuming that, arbitrageurs have access to some separate market with deep liquidity, which again, for some pairs of assets, is not going to be true. But like for ETHUSDC, I'd argue that's basically true. If you were trying to tackle some of these other questions where you had to think about, behavior of liquidity providers, right? So like, how do they react to changes in fees? Then you need some sort of model, I would think, of like, what are the collection of markets that people have available to LP in, right? And then you do start, I don't know that you'd explicitly want to model multiple chains or something, but it seems like you'd certainly want multiple different AMMs that would be in effect competing with each other, which might really sort of might really interfere with some of these ideas of trying to generate more revenue when sort of the lever is going up. Does that make sense? Okay. Yeah. Well, I mean, traders might be more interested in trading in the AMM with better prices, right? I mean, so yeah. Okay, so the question, okay, I still want to make sure I understand the question. Are you saying like, I claim that like, if you did number two, they'd be more willing than before to trade on the AMM. Do we agree with that, or? Right, but you're asking about the traders, you're asking about the LPs. Right. Right, but I mean, you could ask that question without any of this stuff. You could even say like right now, why would anyone bother to trade on an AMM? Like a non-arbitrageur, right? You can ask that right now. And presume like revealed preference shows us that there are reasons, right? Maybe it's because, right, already, you have kind of, self-custody over your funds. You don't want to give that up to do trading. So you just want to do sort of pure on-chain trading. So apparently there are people who are interested in trading on AMMs as opposed to centralized exchanges, even when you're getting sort of crappy execution, okay? And so this is just making the execution better, right? So the loser of sort of number two is the arbitrageurs, right? So people who were making money just from correcting kind of stale spot prices, that's, so the gains to the LPs are sort of lost profits of the arbitrageurs. That's sort of whereas like for noise traders, I don't know why you would object to number two. Yeah, okay. Yeah. Yeah, that's a good question. So the comment is that if you make an equilibrium assumption so like, because anyone can LP and so it's competitive, right? And there's like very low barriers to entry, you might expect that, LPing at equilibrium would be getting you just sort of some nominal return. And so the comment, which I agree with, is if you make that equilibrium assumption, that means you should be able to back out sort of the volatility if people are reasoning about it correctly. That's true. I mean, so in this model, sigma that we care about is like the sigma on Binance, right? Which again, like you can just measure it directly. So there isn't really a need to Right, that's one of the things that's nice about this. Like sigma is like a quite easy thing to measure from data. So you'd be more tempted to do it the opposite. You'd more say like, given that this is sigma, to what extent are liquidity providers at equilibrium? That would actually kind of be the way I would probably ask that question. So good. So no, we have not like, we've been doing empirical experiments. I don't have slides on, but for us, the sigma is always the sigma coming from a sort of like deeply liquid centralized exchange. Yeah. Let's see. So a trading, I see. So you mean you want to like, for example, mess around with the invariant curve as a So the question was, could you actually have the mechanics of the AMM itself adapt, correct? As like volume and volatility, as you observe them changing, basically. Yeah, I don't know that we've thought. In general, this theory is not really meant to compare, say, different invariant functions. I mean, the one lesson you could take away from it is if you remember the formula for lever, it had that marginal liquidity in it. And so the one thing you could try playing around with is, can you sort of change the way the AMM works to manipulate that marginal liquidity to keep, to somehow keep the lever from growing as quickly? We haven't thought about that, but that's like the one thing I could think of that might lead somewhere. Does that make sense? Okay. Yep. Yeah, that's a great question. So this is basically a question about the model of price movements that I mentioned, that we're just using the simple geometric bounding motion. And I would say, nothing else. So I definitely think it's a great research direction is to explore alternative, more sophisticated models. I will say, like any other model you'd write down, I think would be more controversial than the one that I wrote down. So I'm not saying there aren't well-known problems with it, but I actually think it is like the least controversial place to start. Another thing that's actually quite interesting is like, so in some traditional market microstructure, you actually you need to add jumps to your Brownian motion, like for two reasons. One, just to match data, and two, just because otherwise you don't really have a reason why you'd have an informed trader in some sense. So jumps are the way you kind of force arbitrage opportunities into the model. And so here, because you have these price movements external to the market, there's actually sort of more natural entrance. So actually, we don't need jumps to have meaningful analysis, because the price discovery is happening sort of outside the AMM. And furthermore, again, I need to add some more slides, but our initial empirical investigation showed that the model is frankly quite a bit more accurate than we would have thought, actually. So that, even that like sigma squared over 8. So what do? So we take the prediction of our model, which is the sigma squared over 8. And then we actually just look at sort of, empirically, so we basically run that rebalancing strategy just as like a counterfactual. And then we compare that. So we look at the rebalancing strategy without any trading fees. We compare that to sort of the actual net P&L of the liquidity providers, which includes both poor AMM execution and the trading fees. And it actually matches that sigma squared over 8 much better than we were expecting. So, again, I do think one should look at more sophisticated models, but the usual reasons that you're forced into more sophisticated models, because otherwise you don't match the data at all, or just because there's no non-trivial analysis to do, actually neither of those hold here, which is sort of interesting. Stop. Is that what that is? Okay. All right. Okay, so I'll definitely be hanging out for like at least another hour or so if people want to chat more. So thanks so much. So.
All right, guys.